Hello and welcome to our latest Insider interview. Today in the studio I have with me Henry Dixon, Fund Manager of the Man GLG Income Fund. Henry, thanks for your time today.
Thank you for having me.
A notable trend for a number of years now has been UK fund investors venturing overseas for income, which has seen a lot of money go into global equity income funds, and a lot of money has come out of UK equity income funds. What's your thoughts on that trend, and how would you try and convince someone to back the UK today for equity income?
Yeah, absolutely. I think the exodus for UK assets has been well documented and consistent, and that's clearly on one hand a huge shame. But I guess if you look forward now, you would say the relative value metrics are outstanding really versus history. So if you look at relative value on earnings, and certainly the dividend yield on offer now is well in excess of other global markets, even other good value markets globally. So I think the value is becoming quite apparent. And I think, it's not until investors start to see that value being rewarded that maybe they might respond to it. But I think it is pleasing, and we looked last year in a year where it was so brutal for, vast proportions of the asset spectrum, almost the entirety of the asset spectrum, that the UK market actually registered a positive return and the fund managed to slightly beat that. So I think that's very rewarding, and I think it should give people sort of cause for thought in a slightly higher interest rate environment that value does have a part to play. I think the other thing that's important, if you look at M&A trends and you compare them globally, it's certainly the case that probably by number, some of the most active market I think in the world right now for M&A is the UK market, and I think that's corroboration of value from businesses, from trade buyers, from private equity. And so I think there is now sort of a reasonable amount of evidence building that the value is, not maybe just being spoken about by UK fund managers, but it is also being sort of rewarded by, I think, investors with better performance and then also corporate activity.
And that better performance, particularly over the past 18 months or so since interest rates have started going up, that's been driven by the fact that certain value sectors have performed well, the likes of the oils and the miners. Do you have exposure to those areas, and what other companies have fared well for the fund?
Yeah, absolutely. I mean, certainly, if I think about 18 months ago, we were exposed to both oil and mining. I felt at the time mining was, if you like, a less controversial part of the portfolio because it was deemed to be part of the solution, not necessarily the problem. Metals like lithium, cobalt, copper, these were all clearly going to be part of, if you like, the new economy that we looked in. And it was certainly a cheap sector 18 months ago. We actually sought to move on from mining quite clearly, middle of last year towards the end of last year. The rationale there being that we'd started to see some cost creep, started to see some slight change in trend in investment intentions. And if you start to see some more supply creeping on, that can have definitely detrimental effects for the prices of commodities. And I think that's started to play out now. Oil was a hard decision, certainly 18 months ago. It was very, very sort of, it was a very sort of tarnished sector. But we absolutely saw a sector that I think was trading in many ways sort of under the wrong name. It was ultimately a gas sector, not an oil sector. And we absolutely thought gas had a part to play in energy transition. And we saw huge value 18 months ago. We've actually, in similar fashion to mining, but not quite as much, it's still a reasonable sector. We've been keen to take some money out of the oil sector lately, just because, if you like, 18 months ago we had unbelievably good value, we had fantastic free cash flows, and critically we also had really good momentum because of where the oil price was. Now clearly the oil price today doesn't provide you with that momentum. And then if I think about other areas that have really benefited from interest rate rises, I mean, we shouldn't underestimate, I think, the sea change in interest rates. I think it's transformed the competitive dynamics of a few sectors, in my opinion, because I think in so many places you saw new entrants who weren't really playing by the rules of capitalism, which is when you start to lose money, you think about stopping. In an era of free money and zero rates, they were happy to keep funding losses, which was very, very difficult for certain incumbents. So I think about, the demise of Bulb Energy, for example, being the rise of Centrica. When a big competitor like that has to leave, that's a huge moment, and can be a really powerful moment. And then also, if I think about, another area that's been very good over the last 18 months would be non-life insurance. I think of names like Beazley. But a lot of capital made their way into their market in an era of zero rates because they were trying to get an excess return. But as rates have risen, a lot of that capital has left. And I think that's, that's very important. And that's really made the company being able to capitalise on great pricing, great volumes, and the shares have responded very well.
So where are you finding the best value opportunities at the moment? Are there any particular sectors that you'd highlight, and what have been the most recent purchases for the fund?
Yeah, so I'll maybe give you a couple of examples. But I think it's now a case that, as we sit today, the mining sector has been very weak. A lot of the excitement over China reopening last year, which I felt was probably slightly misconstrued. I felt it was going to be more service-based excitement rather than fixed asset investment. But you'll see a name like Anglo American down the best part of 30% this year, trading at a level now I think would be impossible to replicate that asset base for the current price on the screen. Very strong balance sheet, net debt EBITDA certainly below 1, valuation modest, 7-8 times earnings with a yield there. So I think we're quite keen to buy into that weakness. I think another area that we've been quite keen to sort of push against some of the negativity that has sort of played its way out in the market with regards to consumer trends. We added Associated British Foods to the portfolio, ABF, which is the owner of Primark, but it also has ingredients divisions, so Twinings tea, and it also has a commodity-based business as well. And again, it was a case of valuation was very low. The shares had been poor, so you're looking, 12 times earnings, very strong balance sheet. Again, you had sort of 10-15% of the market cap in cash. So hopefully it's a recurring theme of areas of the market that have done badly. Maybe sentiment is negative to them, but in all instances, we think we're buying into good franchises, certainly. Great balance sheets, so these businesses have time, I think, to maybe weather a difficult point in the cycle. And hopefully as that cycle eases, then I think you can see a situation where share prices can make some headway.
You have 2 banks in your top 10 holdings, HSBC and Barclays. Do you own the other 3 major UK banks? And why is that sector attractive?
Yeah, we certainly wouldn't want to own all of a sector. We absolutely feel we can own some of the cheapest elements within a sector rather than having a broad base of a sector. And it's certainly an emotive sector at the moment, given events this year. I think from our perspective, our excitement in being invested is we see a lot of the issues that maybe were part and parcel of the GFC not being present. And then I think interestingly we see valuations that at times and in places now are just as cheap as they were even the nadir of the global financial crisis, where you had no idea about the share count, you had no idea if the businesses were going to be profitable. But today you have a lot of profitability, you have valuations on price to book that, as I say, marry up with points in time in the global financial crisis. And based on earnings, it's a huge disconnect versus the wider market at a time when a huge amount of these earnings and indeed their excess capital is making its way back to shareholders in the form of dividend and buybacks, which paves the way for total returns of sort of mid-teens. So it is certainly a slightly controversial area of the market. It's a part that we are overweight, but as ever, you tend to find some of your best returns come from those controversial areas. I think particularly about the position we took in the oil and gas sector 18 months ago. That was very unpopular, very controversial at the time, but did pave the way for good prospective returns.
As you alluded to, the banking sector's been in the headlines of late. There are a couple of US banks that fell into difficulty. Did this change your view on the sector at all? And what are your thoughts on, there's some fears out there that this could be the makings of a 2008 banking crisis all over again. Why is it different this time?
Yeah, I think there are quantifiably 4 differences today with 08. I think firstly, there just has not been the level of lending growth that we have seen in our sector versus in the run-up to the global financial crisis. So loan books almost tripled in size in the 5 years preceding 2007. And when you have that level of loan growth, I think you can sort of see the elevated probability of bad debts, poor lending decisions. So that's not a feature. I think you'd also point to capital ratios being sort of 2 to 3 times higher than they were in 2007, and also critically liquidity ratios actually being some 10 times higher. So that's to say the amount of money, central banks that can cover any deposit outflows. So I think that's important. And again, I would just come back to valuation, which during those fearful months and weeks definitely again got back to lows that we haven't seen since the global financial crisis. So it feels different. The other differences I'd also say is I think the regulators move very quickly, decisively, which maybe didn't happen in the GFC. I think to have these mergers over a weekend, I think draws a really good line in the sand, does it quickly, and I think those types of events do really help not let sort of fear and contagion, to breed into the wider sector. And then there's also, historical parallels for what's going on. I mean, if you go back to the mid-80s, there were significant numbers of US bank failures in the mid-80s. In a given year, you might have a bank failure almost every day. And that didn't disrupt the wider economy, didn't disrupt wider markets nor the banking sector. So I think as we marry all that together, look, we have to be watchful. The key things for us are certainly think about deposit trends, liquidity. Those are the 2 things that we're absolutely monitoring. But while being watchful, with this level of valuation support, it's still an area that we're prepared to back.
And when there was that volatility back in April, was that a potential buying opportunity? Did you add to those 2 bank stocks that you've got in the top 10?
Yeah, absolutely. I mean, we found it easier to add to HSBC, maybe than some of the domestics. The reason for that, I think, is relative valuation versus the global financial crisis. And I also think, actually, the SVB deal by HSBC will prove to be a good one. You know, when you pay £1 for well over £1 billion of tangible asset value, I think that it could quite definitely prove itself to be, you know, a very good transaction. And then also, if I look about the prospective returns, a few of the cash returns have certainly played out domestically. I think about NatWest, which has been prior a very good performer, but I think we're coming to the end of its sort of excess capital return, whereas I think we've absolutely got the capital return ahead of us at HSBC, so that was why we wanted to visit that on the weakness.
So valuation, it's a very important part of your investment process. So when that valuation rises and becomes more pricey, how do you determine whether to sell a company, or do you run your winners?
Yeah, good question. I think sell discipline is absolutely vital. We are very price target orientated, so certainly it wouldn't be a case of we run our winners for the sake of it. We'd have to have very good new information in order to run our winners. I think in general, I make the observation, I think that people are probably better at buying shares than necessarily knowing when to sell shares. And we certainly look very hard at what happens after we sell a share. And it can be the case, and typically is the case, that the shares we sell do go on to outperform. But what's absolutely vital is that we rotate into ideas that outperform that further. So with that in mind, it's absolutely vital you have a really good bench of ideas, and you've got absolutely robust competition for capital within the fund, outside the fund at all times, and you're constantly trying to optimise a portfolio with the most upside, best liquidity, and it's that competition for capital that I think is absolutely vital to ensuring that.
And finally, do you personally invest in Man GLG Income Fund?
Oh, absolutely.
Henry, thanks for coming in today.
Thank you, Carl.
That's all we have time for today. You can check out the rest of our insider interviews on our YouTube channel, where you can like and subscribe. Hopefully, see you next time.